You know, when most observers look at the precious metals markets, what they see is just a simple cycle, the usual ups and downs, but they're mistaken. My analysis shows we're witnessing something far more profound, a permanent structural realignment of the entire monetary architecture. And at the very heart of it, a new protagonist is taking center stage. In this explainer, I'm going to lay out the mathematical certainty of the coming silver price shock.
For so long, silver has been in the massive shadow cast by gold, but now it has emerged as the true driver of this cycle. I don't see it as just some industrial byproduct anymore. No, it is the dazzling protagonist of this market. And that's a fundamental shift in perception, one that's backed by the cold, hard numbers we are about to dig into.
So let me be perfectly clear about this. The market moves we're seeing right now, this is not short-term speculation. This is a complete redefinition of how these assets are fundamentally valued. We are right in the middle of a deep, structural shift.
To really understand what's coming, we have to unlock the mathematical code that governs the relationship between gold and silver. And that code? Well, that code is the gold-to-silver ratio.
The concept itself is simple, but it's incredibly powerful. The gold-to-silver ratio, or GSR, tells us exactly how many ounces of silver it takes to buy 1 ounce of gold. It's the key metric that shows us just how undervalued silver really is relative to gold. And it is the key that unlocks the price potential I am about to calculate for you.
History gives us the context we need here. While the ratio has averaged above 60-to-1 for most of the century, it compresses, and I mean it compresses dramatically during major bull markets. Back in the 2011 rally, it hit 32-to-1, and at the absolute peak of the 1980 bull market, it collapsed to an incredible 14-to-1. This recurring pattern is the absolute key to my forecast.
The formula at the core of all this is beautifully simple. The silver price equals the gold price divided by the GSR. This lets us make a clear, data-driven forecast. So now, let's plug in the variables.
First, we need a credible price for gold to anchor our calculation. My models are projecting a test of the $5,000 mark by 2026, so we'll use that as the baseline gold price for our calculation.
Now I'm going to start with a conservative target for the GSR. I'm projecting a reversion back to that 2011 peak of 32-to-1. This isn't some extreme assumption, it's just a return to a recent established precedent.
And the math is just crystal clear. A $5,000 gold price divided by a GSR of 32, that gives us a silver price of over $156 per ounce. Now, this isn't a guess. It's the direct, logical result of a conservative, historical reversion. But what if? What if the market dynamics start to mirror that explosive 1980 scenario? In that case, the GSR compresses far more dramatically, all the way down to a target of 14-to-1. This is my historically validated extreme scenario.
And this illustrates the true explosive potential. Using that same $5,000 gold price, but dividing by a GSR of 14, the mathematical corridor for silver opens up to over $350 per ounce. This is the logical outcome of a statistical mean reversion in an environment of extreme monetary expansion. It's just math.
Okay, so the math is compelling, right? Now let's look at the market forces that are actually driving these numbers. It all comes down to silver's strategic role and a massive repositioning by major institutions.
This entire price discovery is being fueled by an unprecedented level of outperformance. Just look at 2025. Silver's performance left gold completely in the dust. This is the classic, textbook sign of a late-stage acceleration in a precious metal cycle. It's the moment when silver always takes the lead.
This is where we have to move beyond what I call first-order thinking. That's just looking at the market and saying, oh, prices are rising. The real analysis, the second-order thinking, asks why. And the answer is a massive rotation of institutional liquidity. The smart money is moving capital from the enormous gold market into the much smaller, much more volatile silver market specifically to capture these exponential gains.
So this is the strategic play we're seeing. Gold is the systemic anchor. It's the hedge. But silver is its high-octane counterpart. Its much smaller market gives it that explosive potential, so it reacts far more sensitively to expanding global liquidity. And institutions are repositioning right now to capture that incredible upside.
The mathematical case is clear. Silver is set to close its valuation gap to gold with incredible speed. But you have to understand, the numbers are only half the story. We also have to consider the physical reality of the market.
So, let's just quickly consolidate the key findings of this analysis. First, the market is undergoing a structural, not a cyclical, realignment. Second, the gold-to-silver ratio is on an inevitable path back toward its historical average. Third, this mathematical regression, which is being driven by a huge rotation of institutional capital, points to a clear price corridor for silver, somewhere between $165 and over $350. These are the facts driving this market.
And that is the mathematical case. But it leaves one critical, unanswered question. What happens when the paper market's price discovery collides with physical reality? The answer to that question will determine the true scale of the coming shock. Stay informed. Let me ask you a question. What happens to a global financial system when the paper claims on a raw material don't just exceed its physical reality, but absolutely dwarf it? You know, this isn't a theoretical exercise anymore. We're about to step inside a scenario with this exact breakdown is happening right now.
So that's the core of it, right? What really happens when the promises made in financial markets slam head-on into the hard, unchangeable limits of the physical world?
The year is 2026. This is our time frame. This is when the system reaches a critical point, a moment I call monetary bifurcation. And it's the exact moment the financial market for this metal splits right down the middle.
Okay, so let's get into the first part of this whole breakdown, what I call the paper illusion. You see, for years, the market has just been shuffling paper, trading derivatives, making bets, without anyone really needing to touch the actual metal. But that whole era is coming to a screeching halt. While those digital tickers in London and New York are trying to paint this picture of calm, orderly markets, the reality inside the vaults is telling a completely different story, a much, much more alarming.
And the contrast here is it's stark. On one hand, you've got the paper market, a world of digital numbers, basically an illusion of stability. And on the other, you have the physical market. We're talking actual bars and actual vaults, where an extreme, undeniable scarcity is unfolding by the day. And believe me, these two worlds are on a collision course.
So what's the trigger for this break? What's the catalyst? Well, it's not some slow, gentle drift. It's a sudden, sharp geopolitical shock, a single decision that completely rewrites the rules of the game.
And here it is. The real turning point arrives on January 1st, 2026. On that day, the Chinese government flips a switch and implements a strict export licensing system for silver. Now look, this isn't some minor regulatory tweak. This is a fundamental change to the global supply chain, and it happens at the worst possible moment, just as Western vaults are hitting critically low levels.
To really understand why this is a systemic shock, you just have to look at the numbers. China isn't just a player in silver refining, it's the dominant force, controlling a staggering 65% of the global supply. When a player that large decides to change the rules, the entire system trembles.
And let's be absolutely clear, this is not simple regulation. From this point on, only 44 state-certified companies, all with enormous capacity, are even allowed to export silver. This is a strategic move, pure and simple. It's designed to prioritize their own massive industrial needs over the rest of the world. They are literally building a physical wall around their supply.
And the consequence? It was immediate and brutal. In early December 2025, before the policy even became official, the market panicked. We witnessed a 60% withdrawal of all available inventory from the Western LBMA and COMEX vaults. And get this, in just 4 trading days.
We need to call this what it is. This is the direct result of a global collapse of trust in the West's ability to deliver the metal. It is, for all intents and purposes, a physical bank run on silver.
Now, let's pivot to the paper market, because that's where this crisis truly detonates. The physical run on the vaults is one half of the equation. The other is the massive systemic risk that's been quietly building up in paper derivatives for years and years. By early 2026, the paper-to-physical ratio hits this absolutely astronomical level, 356 to 1. Let me be perfectly clear about what that number means. For every single ounce of physical silver that actually exists in these vaults, there are 356 different paper contracts all claiming to own that exact same ounce. It's an absurdity.
This entire system is what I call a trust architecture. It's basically a house of cards that only stands as long as everyone agrees to just trade the paper and never ever ask for the physical metal underneath. But now, people are asking. Those delivery requests are piling up, and the entire architecture is starting to crack.
And you can hear the market screaming. It's entered a state of permanent backwardation. Now, that's a technical term, but the meaning is incredibly simple. It means the market is desperate to get metal right now. Think of it like this. You'd pay way more for a bottle of water if you were stranded in the desert today than if someone offered to deliver it to you next year. The demand for immediate delivery is so high, the future price has become almost meaningless.
And we can actually quantify this panic. Market participants are paying premiums of up to 38% just for immediate physical delivery. At the same time, the cost to simply borrow silver, the lease rates, have exploded to over 39%. These are not normal market signals. This is the sound of a system in total failure. This phrase you see here, this is the institutional language for a complete and total standstill. It's the market's polite, quiet way of saying the game is over. The lending market has seized up. There is simply nothing left to borrow at any price.
For the big banks like JP Morgan and Citi, who have held massive short positions for years, this is the ultimate nightmare scenario. They are now trapped in a short squeeze of such historic proportions that it makes anything we've seen in previous decades look like child's play.
And so, the physical wall becomes a reality. This market is no longer a financial game of shuffling paper promises back and forth. No, it has become a brutal, physical mechanism where only one thing dictates the price: actual physical availability.
Which brings us to the final and most crucial question of all. Why? Why has industrial demand become so inelastic, so absolutely non-negotiable, that major global buyers will now accept any price just to secure their supply? It's because by 2026, silver's role in the global economy has fundamentally, irreversibly changed. It has now officially risen to become the rare earth metal of the West, a strategic asset just as critical to our future as any other. So what is the ultimate driver behind this insatiable industrial hunger? Well, that answer lies inside the code of the Fourth Industrial Revolution. In our next analysis, we're going to break down the hunger of artificial intelligence, and we will reveal why silver has become its single most critical raw material.
In my previous analyses, I've walked you through the mathematical and geopolitical drivers of the silver market. But today, we're dealing with the final, most critical piece of the puzzle: silver's physical irreplaceability. Welcome to the strategic endgame. Let's be absolutely clear about this. The entire thesis rests on this one undeniable fact. Silver isn't an option. It's a fundamental necessity for the world we are building right now. The stakes couldn't be higher.
So, let's dive right in. The first element of this endgame is a fundamental shift, a formal recognition that has been decades in the making.
Since November of 2025, the U.S. Geological Survey has officially listed silver as a critical mineral. Now, this isn't just some new label, it is the formal admission of its indispensability. This classification marks the official end of an era of ignorance about silver's true role.
Now let's move on to the dominant demand driver for this year and the years to come, a force of unprecedented scale: artificial intelligence. What's really interesting here is the pure physics. You see, AI data centers require an infrastructure of unmatched efficiency. Because silver has the highest electrical and thermal conductivity of all metals, meaning it moves electricity and heat better than any other element, it is physically irreplaceable for the high-performance hardware that's powering this revolution. There is no substitute.
And this right here brilliantly illustrates the scale of it all. The energy demand for AI infrastructure is projected to grow by over 31% in the next decade alone. This massive consumption of power creates a second, equally powerful demand for silver.
This triggers what I call the double demand effect. First, you have the direct demand in the circuit boards and processors for new GPUs. Second, there's the indirect demand, because this massive thirst for energy will primarily be quenched by photovoltaics. New solar cell technologies, despite intense efforts to save material, still require significant amounts of silver paste to efficiently collect and transmit the electricity they generate. We are witnessing a collision of two global megatrends: the digital transformation and energy decarbonization, both competing for the same finite resource.
But every story about exploding demand has another side, the often misunderstood part of the equation: supply. And this is where the real paradox lies.
Take a look at this breakdown. Approximately 75% of global silver production is merely a byproduct of mining copper, zinc, or gold. The vast majority of silver that comes out of the ground isn't even being targeted directly.
So here's the crucial point. The supply is inelastic. Even a significant rise in the price of silver doesn't immediately lead to higher production, because the mining output is tied to the profitability of base metal mines, not to the price of silver itself.
And what about developing new primary silver mines? Well, the lead time from discovery to production is anywhere between 10 and 18 years. A rapid supply response is a physical and logistical impossibility. The supply for the next decade is already, for the most part, set in stone.
The deficits of the last 5 years have already torn a hole in global inventories equivalent to an entire year of human production. We have been in a state of structural undersupply for years.
This leads to a phenomenon I call the 99% gap. While industry and state actors are quietly securing the remaining physical stockpiles to fuel their strategic ambitions, there's almost nothing left for the private investor at a fair price.
So you need to understand, the market is no longer driven by speculation. It's now driven by something far more powerful, the institutional fear of being left without the physical metal they absolutely need.
This brings us to the final phase. The strategic endgame has begun, and the rules have fundamentally changed.
Silver is the critical asset of this decade. Its true price is only just now beginning to be discovered, under the immense pressure of physical scarcity and a technological necessity that is simply non-negotiable.
You've heard the data, you understand the mechanics, but beyond all of that, there is one last variable in this equation, a factor that has not yet been priced in.
An event, prepared in secret, has the potential to send a shockwave through the markets in the coming weeks.
If you want to understand why this information is essential for protecting your wealth, click the link in the description. The time for speculation is over. The time for hard facts begins right now. Secure your knowledge advantage before the market closes the door for good.